Gopal Srinivasan joins us now. He represents TVS Capital. Gopal, fantastic to have you back and thank you for joining us. Normally I would always start with a macro or a big picture question, but with you, I want to keep that aside. Let me start with something which you expertise in. Your potential to identify small and good businesses and your ability to look at companies which can scale up. So in this post-COVID scenario, where are you picking your spots? Where do you think there is opportunity? Which businesses do you think are still small and young and have potential to scale up?
Thank you again for having me here. Private equity is all about how the individual firm performs much more than macros. So I think I'm glad you skipped the macro question from that point of view. I think in our firm, which is now about 12 years old, we've been through about 2 previous crises before, none of course as severe at any point in time. We were actually born sometimes into the womb of the global financial crisis when we started the fund. This of course is also a human tragedy. Our focus right now actually is not on sector specifically, it's more on the liquidity needs of companies. We have a very long history of experience in investing in the financial services sector, mainly half the fund or so. And we are looking really at the lending space, MSME lending space, consumer lending space, very, very closely, and finding great companies that have fabulous management, unique business models, which are small, maybe 1,000 crore books, 1,500 crore books even, and fundamentally seeing whether we could get in and work with them to overcome the so-called chasm. Think of the expression crossing the chasm of the next 2 years and go fly with them to the other side with our experience and our capital. That is one sector in which we are clearly looking at a lot of opportunities, and maybe I'll just stop with that for now. So that is one area we are very, very deeply interested and have several opportunities in that space we're talking to.
Sure. Gopal, I'm just looking at the list of your investments and interesting names there. Nykaa, WonderLa, Holidays. I'm sure during the COVID times, you've had to revisit some of your investments as well. Does it make you a little jittery about business models of some of these names? And do you think it's going to be challenging for some of these businesses to actually survive in the post-COVID era as well?
Actually, one of the things that we always felt we should invest in is businesses that are going to last forever. Very rarely we invest in businesses that are changing the way work is done. We come in after the way of the business model has been somewhat accepted. So as a result, our businesses tend to be very long-term in nature. They are kind of required for society to run and industries and nations to run. So I'm not worried from that point of view in where we are right now. We were in a restaurant business, but fortunately we're not there now. So current businesses we have in our portfolio are in logistics, and they're in lending, and they're in insurance. So we are helping some of those companies with bridge liquidity to overcome, let us say, a 2-year gap. In our mind, essentially, we run the algorithm of essentially saying FY22 is kind of equivalent to FY19, is how we sort of run the algo. And FY23 is the first growth year. So on that basis, we have actually prepared to fund these companies and take them across, because these are great companies and we really are fortunate to have been partnering with those entrepreneurs. So of the 3-4 companies we are quite comfortable. We made one investment actually in the crossing the chasm, which is in DCB Bank. It's an old friend of ours. We invested with them in 2011 and did very well. We like Murli, we like the bank, we like the interest underwriting. So we actually joined DCB Bank again as part of this crossing the chasm strategy.
Where are you picking your spots in the digital space? I mean, right now everybody is excited about investing in the digital space. Now the challenge with the startup space is that, they're loss making, they're burning a lot of cash. One side you've got SoftBank which has collapsed. On the other side you've got a platform like Jio which has got created. Every VC investor we've spoken to, they are clearly of the view that the world will morph into a digital transformation, and what was earlier a slow process will only accelerate. Now the challenge is that if you look at all the options here, the options are that few firms which offer digital services, either they are terribly expensive or are loss making.
Let's cut digital in three different ways, right? One is, I'll say, a typical lending business and saying how digital are they? So in other words, are they a company with a strong digital ability? Second is, let's fundamentally think about businesses which are offering a series of services on a purely digital platform. The classic example would be payments in the financial services space, which is truly the only scaled digital financial services opportunity in the country today. And the third is fundamentally companies that are offering technology to companies that operate in the business. So we cut them into those three slices. As of now, we've been very active in the first one, that is traditional businesses that use a tremendous amount of digital technology. Wherever we invested in retail, we've always pushed the companies to become omni-channel, like we did with Nykaa many years ago. So the second cut, pure digital business like payment, we are looking at a lot more right now. There's a tremendous amount of growth in data services in the financial space, starting with simple things like account aggregators, maybe more complex ideas like credit card solutions that work for SMEs. The third space, which is technology for financial services, is an area we're beginning to explore. Haven't yet found any good companies there. We also invest in business services. So there also we are finding a lot of B2B technology coming up, and that's another space we're spending time. For example, in logistics, you're now finding companies that provide technology solutions rather than try to be full stack themselves. So I think in our businesses, whenever we invest, whether it's GoDigit, which is a digitally driven insurance company with very strong omni-channel presence, or we've invested in Leap. One of the first things we've done when we invested in Leap, a logistics pallet renting company, is now they've gone through about 50-60% digital transformation. So you can use digital in many ways. We must be very clear what we mean by digital, I think.
Okay. You invested into theme parks like WonderLa in the past. That's indirect play on consumption and per capita rise. What is the best way to directly or indirectly invest in India's evergreen theme, which is consumption, uptick on demographics, and per capita income going higher? Where are you picking your spots there?
So right now, I think we still think there's a lot of opportunity left in financial services, because remember, all borrowing by MSMEs or consumers is largely still a play on capital on GDP growth, right, and economy expansion. So we are spending a lot of time there. That having been said, couple of areas we are looking at more actively. One is in the area of agriculture. Agriculture is actually going to be, in our mind, the four sort of, like yesterday Governor Das spoke about 5 forces. We actually think of life in 4 forces. The first one is A for agri. The agricultural revolution, which is going to come now, is truly the second green revolution. The government has removed a lot of the shackles in terms of APMC Act and basically setting up the FPO infrastructure over the last decade or so. That I think is a big opportunity. So agri is one area we are scanning very actively, and agri in various stages. It could be agri-tech, it could be post-harvest processing of grains, it could be post-harvest packaging of food. That is one space I think we should all be looking at. There's a saying in India that agriculture has great potential. Unfortunately, it has always remained that way for investors and never really seen performance. I think that's changing. I think this is a great time to go to agri, and I think startups are playing a very important role in bringing that innovation into agri. Like, for example, our own Way Cool in Chennai as a fruit and vegetable integrator, or in many ways Big Basket in Bangalore, which actually has a 17-18% revenue coming from fruit and vegetables.
Sure. Gopal, that's a really interesting comprehensive strategy and very forward-looking, of course. I wanted to also get a sense of valuations, given the kind of phase that we're going through. Would this be an opportune time to perhaps even ramp up investments in current holdings, which could be available at lower valuations currently, with an eye to the future, continuing to, of course, validate your conviction in those stocks, or would you be looking for a whole host of new opportunities to get into?
I think the way we think about it, and this is what we've been doing during the COVID lockdown period, is very simple. If you're investing at a steep discount in a good company, you better really understand that business really well. You cannot go in there and look for navigators and compasses and maps. You need to go there fully equipped. So when you cross the chasm is how we describe those opportunities, which are good companies at a very, very good price. I think those are few, but it is only like, it's like basically going into cave exploration or deep or cave diving under the sea. You must really, really be good at what you do. And that is the model we are following there. I think only a Sherpa can climb the Himalayas, in our opinion, when it comes to this area. As far as the other spectrum is concerned, there are still some really, really good small to mid-sized companies available. The prices haven't come down. To be frank, everybody is quoting pretty much pre-COVID prices in the private space. There's an old saying that public market is like the ocean. It goes up and down at rapid speed, but private market is like treacle. It comes down very slowly in terms of pricing. And that's the situation today in private markets. It's still slowly beginning to come down. People are willing to now take forward pricing convertible structures. People are willing to give maybe a 20% discount. But there our whole approach is to go for great companies. Go to the best entrepreneurs whom we always wanted to be with and try to see whether we could maybe at a fair price, maybe on a December for multiple or a March 21 multiple, agree for a fair conversion based on the performance then. That is what we are trying to do. So our focus is either a good company which we understand, like lending at a very, very good price, or great companies. Maybe we don't get a huge price discount, but we anchor it on some reality of the future, like December or March. And we prefer the latter. So great companies at a fair price would be a kind of idealistic scenario for a private equity investor today. And just to finish, private equity investors, I don't think I've never ever seen a...
I mean, I noticed, for example, WonderLa Holidays on the list of portfolio companies. I'm just curious, in sectors that have been really badly hit, what's the outlook, Gopal, going forward? You know, how long do you see before we actually turn the curve? Because globally, when it comes to travel, we're hearing as far as maybe 2.5 years before we see a substantial sign of recovery.
I would think from a perspective, the human tragedy of COVID is enormous. The death rate itself, as you could see, is in India not significantly different from many other diseases, or for that matter in the world. So I think the whole issue really is the entire lockdown the policy management of the disease, and the amount of shockingly tragic human disaster stories it is creating. So our own outlook based on that aspect, which is really what is pulling down demand and supply in the economy, is I think we should think a company should be able to survive for 3 years to make it to the other side. FY23 is the other side in our opinion, bereft of any magic vaccine or sudden remission of the disease. So our basic view is we look at so you took the example of WonderLa. I happen to be a board member, so I will not comment on the internal part of that company. But speaking broadly, say take 6 parks in America or Disney theme park division data, which is publicly available, you need to be having enough capital to pay interest and debt for at least 2 years. So I would say think FY23 as your first growth year. And in anything, if you cannot keep it liquid and solvent for that period of time, it's better not to do it. But the opportunities are phenomenal, I think, in the travel, tourism space, massive number of opportunities. And it's for those investors who have that kind of ability to fuel that 3 years and bake that into the pricing, right? The pricing needs to reflect that 3-year period of support. But FY23, our mind is focused on FY23. FY23, our mind, in our mind, March 23 will be 105 if March 19 was 100. March 23 will be 105 if March 19. March 20 was 100.
Gopal, closing comments. We always ask people what are they... Fair point. We always ask investors and our experts that please tell us what you are looking at buying. Please give us a sense of what is there on your radar. So I'm sure you follow a thumb rule where you also have to follow a list of elimination. Like they say that it is important to avoid rather than focus on everything. So what would you not buy in this market, whether it's because of valuations or because of the business or because of the environment?
Generally, I would avoid buying any business which is labeled as COVID positive, because the valuations there, I think, are more related to supply demand gaps and therefore EdTech is a classic example of, I think, don't do right now. I think in anything to do with the premium healthcare, which is directly linked to COVID, I think one should avoid those kind of stocks right now, those kind of companies right now, because it's just the promoters don't know what's happening. They have 100 people waiting on the Zoom waiting rooms. So I think it's better to just go with businesses that you understand. And for us, that has been the main focus. During times of difficulty, focus on what you know. Do not venture of what you don't know. For us, it's financial services and B2B services and some niche consumers. So the first two primarily is where we are spending our time. This is a time when there is time of darkness. Whatever little puny torch that each of us carry, that light should be guiding us, and not a sense of over understanding or a sense of hubris that we understand something which we don't understand. So we are very, very careful to go after things we understand, but are willing to take steep risks in those areas. And that is where we see an alpha creation for our LPs.
Gopal, great to have you on the show today, and thanks much for sharing all your insights. We should chat again soon.
Thank you. Thank you so much for having me. All the best. Bye.